Welcome to this explainer. Today, we're basically playing financial detective. We're going to dive into a wild paradox hidden right inside the numbers of Guardant Health. If you've ever wondered how the market prices a company that's growing at just breakneck speed, but at the same time burning through hundreds of millions of dollars, well, you're in exactly the right place. We're tearing down their financials, relying purely on the data to really understand this massive tension between top-line success and bottom-line reality.
Okay, here's our game plan for today. We're going to hit 5 key areas. First, the price roller coaster. Second, the revenue engine. Then the profitability problem. After that, debt and liquidity. And finally, market valuation metrics.
All right, let's jump right into section 1, the price roller coaster. And yeah, we're talking about some seriously unpredictable market moves here. Just to give you a sense of scale right off the bat, Guardant Health commands a massive market cap of over $11.6 billion, with the stock recently closing around $88. Listen, this is not some tiny, under-the-radar biotech startup. This is a massive enterprise, and the market is heavily invested in it. But, as you'll see, getting to that $11.6 billion mark, yeah, it has not been a smooth ride for shareholders.
Seriously, just look at this whiplash. Investors who held on through 2022 took a crushing 72% hit. Ouch, right? Then the stock basically flatlined in 2023, crept up about 13% in 2024, and then boom! 2025 hits and we see an unbelievable 234% gain, just totally rewriting the narrative. But wait, fast forward to year-to-date 2026 and it's pulled back again by about 13%. I mean, talk about extreme volatility.
Which brings us to section 2, the revenue engine. Let's look at their top-line success.
So what's actually fueling this multi-billion-dollar valuation and all that crazy price action? Well, the answer is sitting right at the very top of their income statement. Over the trailing 12 months, Guardant pulled in an absolutely massive $982 million in revenue. They are literally knocking on the door of $1 billion in annual sales. And in healthcare tech, crossing that billion-dollar threshold is a huge psychological and financial milestone.
And here's the really crucial part. This is not some one-off fluke. When we look at their compound annual growth rate, or CAGR, they've kept up a blistering pace of nearly 30% consistently. We're talking 29.7% over the last 3 years and almost 28% over 5 years. Honestly, maintaining a near 30% growth rate for half a decade is incredibly hard to pull off. It's exactly the kind of engine growth investors are constantly hunting for.
But section 3, the profitability problem, or as I like to call it, the leaky bucket.
Because every good financial mystery needs a plot twist, right? Look at this stark contrast. While nearly $1 billion is flowing in at the top, they are bleeding over $416 million in net income at the bottom. This right here is the central paradox of Guardant Health. It seems like the more they sell, the more money they actually lose.
To figure out just how deep this profitability problem goes, we have to look at ROIC, or return on invested capital. In a hyper-growth environment like this, ROIC is kind of the ultimate test. It tells us if management's capital allocation is actually building a sustainable business model for the long haul.
And well, the results aren't exactly pretty. All their return metrics are deeply, deeply negative. ROIC is sitting at minus 23.5%. Return on assets, negative 24.8%. But the number that really jumps off the page is return on equity, plummeting to a mind-boggling minus 419%. When you see a negative return on equity this extreme, it's usually a giant red flag that years of massive historical losses have just completely chewed through their shareholder equity base. So where's all that money going? The culprit becomes pretty obvious when we check out their profit margins. See, they actually make a really solid 62.6% gross margin on their products. That means the core product itself, highly profitable to make. But once you subtract all the operating expenses, we're talking massive R&D, huge sales and marketing costs, the net profit margin violently swings to negative 49.8%. Basically, they're spending an absolute fortune to fuel that 30% revenue growth we saw earlier.
And guys, this isn't just some weird accounting quirk. It hits their actual bank account. Those massive operating costs translate directly into a negative free cash flow of over $233 million over the last 12 months. Think about that. They are burning through nearly $250 million in pure cash every single year just to keep the lights on and keep growing.
Which naturally leads us to section 4, debt and liquidity. How are they keeping those lights on?
I mean, with a cash burn rate that high, the very first question you got to ask is simply survival. Can they make it? We need to check their short-term liquidity,
specifically the current ratio, to see if they actually have the financial runway to cover their bills over the next 12 months.
Well, surprise! Despite that massive cash burn we just talked about, Guardant actually has incredible short-term liquidity. With a current ratio of 4.84 and a quick ratio of 4.56, they literally have nearly 5 times the amount of liquid assets they need to cover their immediate liabilities. So, long story short, they have plenty of cash on hand to survive right now and keep funding that massive burn rate.
But looking further down the road, their long-term structure is definitely concerning. Just look at this deeply negative debt-to-equity ratio of minus 15.14. Normally, you'd want a nice, positive, manageable number here. A deeply negative ratio like this is basically a scar. It shows that years of accumulated deficits have piled up, meaning their total liabilities absolutely dwarf their assets on an equity basis. So yeah, they're surviving on cash reserves today, but their underlying structural health, it's heavily compromised.
All right, let's wrap things up with Section 5, Market Valuation Metrics. Let's see how the market is pricing this paradox.
Because really, we have to ask the $11 billion question. How on earth does the market price a business that has stellar, consistent top-line growth but absolutely abysmal bottom-line metrics? When we look at enterprise value ratios, the market is clearly paying a massive premium for that growth story. They're valuing the whole enterprise at more than 12 times its actual sales. That's an EV to sales ratio of 12.17. To put that in perspective, investors are eagerly paying $12 today for every single dollar of revenue the company brings in, totally ignoring the fact that underlying earnings, which you can see in that deeply negative EV to EBITDA ratio of minus 30, well, they basically don't exist.
Honestly, traditional valuation methods just completely break down here, because Guardant has no earnings, no positive book value, and no free cash flow. The price to earnings, price to book, and price to free cash flow ratios all live in deep, deep negative territory. You literally cannot use old-school value investing metrics on this company. The market is valuing it entirely on its future growth potential and those top-line sales.
And what's even wilder is that investors today are actually paying a huge premium compared to the company's own recent history. The current price-to-sales ratio is 11.86. That is a full 38% higher than their 3-year historical average of 8.59. So the market is actually getting more optimistic, happily paying a higher multiple for that billion-dollar revenue stream, completely unfazed by the ongoing cash burn.
So we're going to wrap up this explainer with the ultimate question you have to ask yourself as an investor. In the crazy volatile world of high-tech health, is explosive top-line growth really worth a massive cash-incinerating bottom-line burn? Guardant is doing a brilliant job capturing market share, but they are clearly struggling to turn that dominance into actual, profitable reality. So what do you think? Are we looking at the medical technology giant of tomorrow, or just a $12 billion house of cards? Thanks so much for joining us today, and until next time, keep questioning the data.